There's also the scenario where America pops the financial market bubble in the Western world, creating a new crisis. Then, at rock bottom prices, the U.S. could buy up its allies' core assets, further tightening control over them and influencing their future policy decisions. This move could also help alleviate the asset shortage caused by the excessive money printing of the dollar. Hello everyone, I'm Jeffrey and welcome to Just Spit Out. Today, I want to talk about the struggles of the US dollar. America has cut interest rates by half, but right now the dollar is in a difficult position. It's stuck between rising and falling, neither up nor down. This situation brings significant risks. The main problem is the cost of capital. For a long time, it's been said that there's a safety line between US economic growth and the interest rates on US debt, which is roughly 3%. This is the limit that the long-term market capital can bear. Once the rate exceeds 3%, the cost of capital for U.S. financial markets will significantly increase. The market returns will likely fail to cover these costs, which could lead to a massive outflow of funds, triggering a collapse in the financial markets. In the previous U.S. rate hiking cycle, when the Federal Reserve raised rates to 3% in September 2022, a series of chain reactions followed, including the UK pension fund crisis, the Swiss Credit Suisse collapse, and the geopolitical tensions from Russia's partial mobilization, leading to an escalation in the war. In general, the 3% rate level maintains a relative balance from the financial markets to financial institutions and geopolitical pressures. Exceeding this level increases pressures across the board and greatly raises the cost of maintaining financial stability. Currently, the U.S. rate is at 4.5%, which still puts the country in a high blood pressure situation. The U.S. needs to lower the rate to below 3% as soon as possible to ease the tension. But the challenge for the dollar is that if it cuts rates quickly, the domestic dollars will have nowhere to go. If large amounts of dollars flood out of the financial system into the economy, U.S. inflation could worsen again. Although Trump wants the Fed to lower rates quickly to reduce financial costs, he clearly understands the risks behind this. The Federal Reserve is walking a tightrope. Trump's nominee for the new U.S. Treasury Secretary, Scott Bessent, has also stressed that the U.S. needs to maintain a strong dollar policy, which aligns with the Fed's objectives. Federal Reserve Chairman Jerome Powell, in the latest hearing, stated that the Fed is not in a rush to cut rates further. Powell said the policy is prepared to address risks and uncertainties, and there's no need for immediate adjustments. Looking ahead, Powell mentioned that if inflation doesn't continue to drop toward the target, and the economy remains strong, the Fed may keep rates unchanged for a longer period. After the Fed cut rates by 100 basis points last year, it paused further cuts last month, leaving the benchmark rate in the 4.25% to 4.5% range. The market now generally believes the first phase of this rate cutting cycle has ended, and the next rate cut may not come until after September. The dollar, from both an economic development and financial stability perspective, needs to lower interest rates below 3% as soon as possible. However, the U.S. needs to find a destination for the dollars before it can cut rates further. In the past 2 years, the U.S. rate hikes created a counterintuitive phenomenon while interest rates were rising. The stock market was also climbing. Now, as rates are being cut, the stock market is still rising, which highlights a big problem outside of China. There are no undervalued assets left in the world. Without these undervalued assets, the vast amount of dollars in U.S. stock and bond markets has no place to go. This is the current dilemma for the dollar. Further rate hikes are impossible, but cutting rates seems tricky for now, as it could drastically worsen U.S. inflation risks. This leaves Trump with a tough decision. This is why I say that Trump may need to seek strategic coordination with China, or even a shift in the trade war. The reason is that Trump now has to balance a strong dollar while lowering rates and controlling inflation risks. One potential solution is to significantly reduce oil prices. However, to lower oil prices, it may require lifting sanctions on Russia and Iran, while also appeasing Saudi Arabia, of course. Reducing oil prices to control inflation and creating space for rate cuts is merely a temporary fix. The fundamental issue America faces is positioning the dollar post-rate cuts and whether it can effectively secure enough core assets after cutting rates. From Trump's first term to Biden's administration, America has been printing money and the size of U.S. debt has ballooned. In reality, America's main problem is how to expand its balance sheet. It could annex Canada, but that doesn't solve the immediate issue. During the years of America rate hikes and cuts, asset prices in Western countries have surged, and the purchasing power of the dollar has decreased significantly in those countries. In other words, the cyclical forces created by the dollar have aligned poorly with the current asset price cycle, causing a dollar shortage. There's too much money, but too few quality and affordable assets. To solve this problem from the U.S. perspective, there are two options. One is to achieve a comprehensive strategic reconciliation with China and make large-scale investments there. Clearly, under the current international situation and future America's strategic planning, this seems nearly impossible. The other option is for America to burst the financial market bubble in the Western world, create a new crisis, and then buy up its allies' core assets at bargain prices. This would allow the U.S. to deepen control over those assets, influence the policy-making of its allies, and alleviate the asset shortage after massive money printing. This is the background behind the current dilemma facing Trump and the dollar, and why America may need to seek strategic coordination with China to divide influence. Without that, the dollar's asset shortage problem will be difficult to resolve. Appreciate your listening. Love you guys. I'm Jeffrey. This is Just Spit Out. Hit the subscription for more observations. I will see you next time.